Welcome to Wealth Management Mixtape, a go-anywhere show about life, finance, and investing. Join Jake Heisler and Tim Miller as they talk about what they're reading, writing, and experiencing. Jake Heisler and Tim Miller work for Quaker Wealth Management. All opinions expressed by Jake and Tim or any podcast guests are solely their own opinions and do not reflect the opinion of Quaker Wealth Management. This podcast is for informational purposes only and should not be relied upon for investment or financial planning decisions. Clients of Quaker Wealth Management may maintain positions in the securities discussed in this podcast.
Well, we should welcome everybody to season 2, we're calling it. So this is our 17th episode, so we're pretty proud of that. Most of it through 2021. Do you remember when 2022? Do you remember when we started in 2022? Any I can't remember.
It had to be before summer.
Yeah.
I think it was like
Definitely
late spring.
Yeah. Okay. I don't know. I think we did pretty well. I think we learned a lot, right? I would say. I mean, we did everything ourselves. Editing, recording, figured out what equipment to use, that sort of thing.
We've also created an offshoot of what we do here at Wealth Management Mixtape, and that was called what you named the Shake Up.
Yeah, Shake Up.
And we interviewed in our first, 7 or 8 months of recording, we interviewed 2 CEOs, which was pretty neat.
I always found that very interesting. So the goal is to interview leadership, folks that are in leadership in industries that are looking to shake up the kind of status quo. And I always learn a lot in those conversations. That's the fun part. And it's fun just getting to know the people, the individuals too. I mean, CEOs are also people, right? So they have interesting backstories and reasons they got to where they are. So
yeah, I think it's also interesting to hear the different businesses that they're in, different market conditions that they face, and also what stage of the business they're in. And it just so happened to be that both CEOs we spoke with seemed to be early stage companies that they were trying to navigate, product market fit and the rollout of different products or subscriptions. And, I think it was really interesting to kind of hear how they were both similar and different in their some respects. Yeah.
I am interested to see how Hive Mapper's doing. I keep pretty close track of it. I don't have a dash cam, so I'm not earning honey tokens, but apparently that's up and running. And Ari will share the updated maps on Twitter ongoing. So it's working. I was curious to see how it was going to do since it lives on the blockchain, right? The honey tokens and the incentive to keep mapping with everything that's gone on this past year in crypto.
Has he posted any statistics on how many people have dash cams in the U.S.?
No, I'm sure I might have missed it, but I'm sure that data's out there. They seem to be going. They're working on a second generation camera now at this point. I guess it captures more territory or whatever as people are driving around. So it's they're seems like they're moving in the right direction, which is cool to see. So speaking of 2022, it's worth just a quick recap of things that we thought were kind of shocking or interesting or whatever. We mentioned crypto. That was were you shocked by the FTX thing? I mean, I was. So
I think all of us were. I'd be lying if I said I wasn't. He seemed to be what was in a very unstable, market, a very unstable, unregulated market. He seemed to be the voice of stability, only to find out that he was the least stable of, any of them.
Yeah, it's. I was at one point I was worried about where I own a little crypto. It's not enough to make a huge difference, but I had it at one exchange, and I was thinking, wow, man, maybe I should move it off this exchange. What's the exchange with the most strength right now? I was like, it's got to be FTX, right? Their name is everywhere. Tom Brady was a spokesperson, and I didn't move it. That was probably more out of sheer laziness than anything else. But I'm thankful I didn't. It's just in these newer. I mean, these bad actors exist in every industry, and it seems like they can wedge themselves in further in an industry that's newer and less regulated. So a newer concept, and but what he was doing, allegedly taking customer deposits and moving them over to his private equity firm or whatever, is kind of the shell game that a lot of these other bad actors have, right? They move certain assets and then they're not supposed to touch it, and they do, and then eventually it all kind of tumbles down like a house of cards. So I was surprised it was FTX, because that was held up as as the grandfather of the industry type of thing, the most stable, and this genius that was running the show there. They had a stadium down in Miami, right? I think.
Yeah, FTX Arena where the Miami Heat play.
Yeah.
I think they said that that the naming rights will be stripped, if they aren't already, very soon.
Yeah, that guy's going to jail for some time, and he's an idiot. These guys are look. There's some. I mean, I hesitate calling it mental illness, but they're borderline psychopaths that they do all this wrong stuff. And then he did like a Twitter interview right afterwards, like a Twitter Spaces interview, and I'm assuming just incriminated himself, right, in the stuff he was saying. So it's just these guys can't get enough of the attention. I think a lot of these folks. It's rare these days that you see a founder that's really behind the scenes. At least maybe we don't see them in the public because they're not brought to the public eye. But it always seems like the biggest companies, are the loudest.
Yeah. You're saying like FTX was kind of the grandfather or stability within an unregulated industry. And to your point, it seemed like during a time of volatility where obviously the price of a lot of this cryptocurrency had been cut in half or even a fourth, or a lot of them lost a lot of their value, they were buying up a lot of the other struggling exchanges. Why it was so ironic that FTX then collapsed with customer withdrawals is because they had just been the one bailing out everybody else. So, when volatility can uncover some of these bad actors in certain points. And I wanted to ask you, I don't believe, and I don't know if you think, there will be any FTX commercials in this year's Super Bowl.
Not a chance.
Do you think that any of these
their money?
Do you think any of the spokespeople like Larry David or Shaquille O'Neal or Tom Brady, do you think there'll be any blowback on them in any way?
I mean, Larry David, do you think he knew what he was getting into?
No idea.
Yeah.
But there's people like Kevin O'Leary who are, they got paid in FTX native token, and now they're trying to explain, as an advocate for the platform, why they were advocating. But I don't know. I'm asking you if you think there's going to be any blowback on the Kevin O'Learys or Shaquille O'Neal, those types of people.
I mean, the reason that, Larry David got it is because it was ironic that it was Larry David talking about, on a commercial for FTX. I don't think he gets any blowback. Isn't this just an extension of like the influencer world? Like, we tout products, Gatorade Fit or whatever, right? No sugar and no dyes, or, these celebrities or whatever have it on their Instagram or TikTok or whatever it is these days. And they don't use it. You know what I mean? They don't actually believe in it. They just get compensated for it. So no, I don't think it's gonna be any blowback. I really don't. I think for Kevin O'Leary, I mean, he's the guy that holds himself up as a financial expert, right? We're going to talk about that in a second. He's one of those talking heads that's always on television. But I'm not sure it's for his It's not for being smart all of the time. So anyway,
Yeah, I feel like Kevin O'Leary would have a much greater effect on people trusting his judgment in a financial company than Larry David would. And in Larry David's defense, the entire commercial was that he didn't want to invest. So
yeah,
if anybody's good out of any of those people, it's definitely Larry David. But I agree. I see Kevin O'Leary almost, it seems like every other day on CNBC trying to, innocent until proven guilty, or, he wants to find all the facts and ask Sam Bankman-Fried personally where his money went. And Sam Bankman-Fried has assured him that there was no commingling of funds. I think it's all kind of BS, but we'll see where it goes.
yeah. I don't know. We'll see. Well, 2022 was a crazy year, so we'll run it through real quick, just from a market perspective. First year since 1928, I think it was, that both the stock market, the S&P 500, and the bond market were down double digits. I think the S&P ended up down almost just over 19% for 2022, and the bond market was down just about 13% for the year. That's, I mean, we use the term unprecedented probably too frequently with the media the way it is these days, but that really is. I mean, that was once since 1928. That was wild.
And there's years where we're going to see the equity market down double digits, but how many times in the last 40 or 50 years have we seen the bond market down double digits?
Yeah, none.
Once? None?
Yeah. Oh, this is it. Yeah, this is it. So, yeah, this is the idea. You always get the same articles during an environment like this where there's some correlation of all risk assets, bonds, and stocks move in the same direction, or gold, which really wasn't an inflation hedge this year, just also was down. You get the death of the 60-40 portfolio, those folks coming out saying it's dead, because bonds didn't do the job that they're supposed to do during a down market. But we have to remember that the job of bonds is to hold you up through bad economic environments, right? So if the economy is poor, there's a recession, rates drop, bond prices go up. That's the benefit of having bonds in the portfolio. But that wasn't the case in 2022, right? Stock market dropped, and the Fed, also unprecedented, was raising rates at an unbelievable pace, which obviously was what drove the bond market down. So we had these kind of combination of factors that was so unique. I still think it's that we call the cinder block in the bathtub analogy, right back from COVID, that we're still kind of working our way out of all of that economic soup we're in. And it's like we have to pull the ingredients back out of the soup now and try to start over. And it's just hard. So, I mean, we can knock the Fed all we want, and we do, especially in the office. But they're in a tricky spot, right?
Yeah. And I think when you talk about the cinder block in the bathtub analogy, where it kind of threw all of the everything we look at from an economic perspective out of whack, it's like everything that we perceive traditionally to be good was bad for the market, and everything that was bad seems to be good. It's almost like the market is hoping that there's higher levels of unemployment. Obviously, that would show that there's an easing to inflation, which obviously is our number one concern, or the market's number one concern, just by the way it reacts to some of these numbers that come out. Obviously, inflation on a monthly basis, some of these CPI reports, but you see these jobless claims, and you see the way the market reacts, and it wants more people unemployed, which traditionally would be a bad signal. But at what point do you think the market flips from, okay, we've seen inflation come down enough, and now unemployment has run a little bit higher than we'd like, and that kind of takes us out of that soft landing territory?
Yeah, I'm curious to see what happens if the Fed sticks to their guns and unemployment data turns over at the same time, or starts climbing, because that's the worst possible scenario, right? So I think you'd see a major market sell-off if that happened. That's my guess, right? But employment numbers were pretty good through 2022, right? That's what kind of helped prop things up. But the market sold off like we were in a recession. So it's just this odd mix. So I don't know much if we enter a true recession in 2023, let's say, right? It seems like everybody's calling for a recession now. The market traditionally bottoms during the recessionary environment. So if it's 6 months, right, during that 6 month period, the market usually bottoms, but we don't usually enter a recession already down, 25%. So it's just this kind of, I don't know what happens. I mean, it's just a mess.
It's
And at some point,
uncharted territory in some respects.
yeah, you can say like this time is different, but it really is. It's different. I mean, the guy that I forget, I'm blanking on his name now, that invented the inverted yield curve, right? That it was always a proxy for future recessions in the next 12 to 24 months. Came out and said, well, hold on, this time might be different. So even the guy who invented it and was so keen on connecting the dots was saying, I don't know for 2023 if that works when there's employment where it is right now. So it'll be interesting to see. I think if anything is going to be, the term now being thrown around is just an earnings recession, right? That corporations struggle to, keep things moving in the right direction from an earnings perspective. And I guess that could affect stock prices, but it doesn't have to.
Yeah. Just in my own opinion, and something that we read or listen to every day, and we hear both sides of the table. Those who think that a recession and hard landing is inevitable. Others are more optimistic on where the market can go this year, thinking it can inflation will come down. We have a chance if the Fed doesn't go as aggressive with interest rates. We can kind of meet somewhere in the middle, have I don't know what they're calling it, a shortened recession or a soft landing, whatever you want to call it. But at what point does the Federal Reserve actually start to tamper down on interest rates? Are we going to see it teeter off in the next 2 meetings or 3 meetings? Or I think that's the biggest determinant, because the indicator for inflation is a lagging indicator, and I think that they know that. And the thing, as we were talking before the show, something that surprised us, right, especially that surprised me, was that the Federal Reserve, most of the time, they try to, in a way, manipulate the market to do what they wanted to do without actually doing what they say they're going to do, which is in most cases raising or lowering interest rates. And I think this time it took us both by surprise that they actually stuck to their guns and did what they said they're going to do. And I think some of that hawkish talk that you hear out of the Federal Reserve is just to say, hey, we're not going to let our foot off the gas earlier than expected. And, we don't want the market to think that we're bluffing, or I don't know, is the market starting to figure out what the Fed does every single time with just calling their bluff, and now they have to kind of stick to their guns in a way?
It feels that way, yeah. I mean, if the bond market's any indication of what the market thinks the Fed's going to do, then it's going to stop raising soon, right? Because the 10-year turned over substantially in the last handful of months. I mean, in the 2-year turned over pretty sharply. So I don't know. I'll give you my my 2 cents on things, right? Totally a prediction. We're going to do a prediction section in a second for 2023. I think that even though there's not supposed to be politics injected into the Fed's decisions, but let's just be honest, right? They're all sitting there in Washington. There's politics, right? You can't avoid that. Life is politics, whether we want to admit it or not. And there's an election next year, right? So this is not pro-Democrat or pro-Republican. This is nothing. This is just reading the tea leaves, right? That if I'm a president and I'm running for re-election next year, I would rather have a bad economic environment, if there needs to be one, or there's a risk of there being one in 2023, right? I want to get it out of the way so I can have the turnaround going into 2024. That's just me, right? If that's the case, then the Fed is listening, right? They're not talking about it, but they hear it in the background. then they have every incentive to keep going, right? Because if the market's going to crash, they need a correction. I mean, if there's going to be a recession, the one way they can do it is they can keep raising rates. They keep talking tough and then following through, and then at some point there's enough demand destruction. It's already starting to happen that we truly do enter a recessionary period. And if I'm running for re-election in 2024, I want it to happen in 2023, so I can show everybody that we got out of it, and that was a big part of it. I don't know.
Makes sense to me. I think something that Jerome Powell is adamant about is learning from the past, and something that who was head of the Federal Reserve in 1980? Was it Volcker?
Volcker, yeah.
Right. Volcker stopped short of taming inflation, so he raised interest rates, and then he stopped. Inflation didn't go away, and he had to come out and raise them, whatever the absorbent amount was that he did. And finally, all these years later, he's remembered as a hero for getting rid of inflation, but he actually took him 2 different tries. Jerome Powell is trying to do it all in one shot and not have to go through, Jerome Powell let his foot off the gas too early, but we'll see where it goes.
There is one factor in the back of my mind that everything right now is pinned to inflation. All decisions are made based on inflationary numbers, and we have oil at just such low levels right now. Like if that just naturally follows its ebbs and flows, and we have oil at $100 a barrel, are we sitting here 6 months later watching inflation turn back up again? Right? That makes sense. Yeah. So, and then how does the Fed react to that? If they don't, I don't know. But if the target's 2%, and if you look at the last 6 months, we're already there at 2%, right? If you're looking at 12 months, it's higher than that, obviously. But I wonder in the back of their minds are saying, yeah, but this is into a low commodity environment. And if that turns back up, which is a very real scenario, we have to be extra aggressive on the front end of this.
Yeah, I agree.
It's going to be another odd year. Let's put it that way, I think.
Yeah.
I think bonds might do their job this year. That's one of my predictions, right?
So let's just use that as a segue into our next section, which is our predictions for 2023. So your first prediction is that bonds will have a positive year after their worst year in the last 50?
I'm saying the 60-40 portfolio is back, baby.
bold prediction.
There's going to be articles written this year, the 60-40 portfolio is back. It was never gone, but...
the author, Jake Heisler?
I'll just tweet it. That's all I have to do these days. That's my first thing. 60-40 portfolio is back, right? Bonds do their job. They act as a ballast asset to the portfolio. That's my number one. That might be obvious. I don't know, but that's my first one.
I don't think anything's obvious post-COVID, but I would say that's more of a slam dunk than other things or other predictions to happen. I guess my number one would be that I think earnings are going to hold up better than expected. I think that earnings projections and guidance has come down so much. And obviously with layoffs and cost-cutting measures, I think that earnings will come in a little bit above where expectations are currently. So I know a lot of the market is now focused kind of now that they're seeing the deterioration in inflation, that now everybody's starting to look at earnings.